Last time this curve dropped below zero was on May 28, 2002. The next time it fell below zero was in January 2025, and it's still hovering around the zero line today. The chart shows the equity risk premium, which basically measures the extra reward for owning stocks over government bonds. That means investors are now taking equity risk without getting paid for it. This exact scenario already happened once, back in the year 2001. The equity risk premium went negative, warning of extreme overvaluation during the dotcom bubble. Not long after, the S&P 500 dropped by 45%. And now, that same warning signal is flashing again. As you know, bonds are way more stable and safer than stocks. And right now, the return from treasury bonds is almost matching what you get from equities. So when that risk premium disappears, it makes stocks look way less attractive and way more dangerous. The basic logic for investors naturally comes to a question. Why take on stock market risk when I can get nearly the same return from bonds? The equity risk premium curve is defined as difference of S&P 500 forward earnings, yield, and 10-year Treasury yield. The 10-year Treasury yield is now sitting at roughly 4.32%, meaning you get 4.32% annually just by lending money to the US government, with virtually no risk. It's considered the benchmark for a risk-free return. The forward earnings yield of the S&P 500 is currently at 3.57%. That puts the equity risk premium at negative 0.75%, meaning investors are now earning less from stocks than from safe government bonds. So how is it that the S&P 500 just hit a new all-time high a few days ago? There are two sides of coin: valuation and earnings. Either companies are making more money, or investors are just willing to pay more for the same earnings. And right now, it's mostly about valuations. Prices are rising faster than profits. This is what we call valuation expansion. It means investors are pricing in future growth, not because companies are earning more today, but because everyone expects they will earn more tomorrow. So the stock market is sitting on its all-time high right now, but forward earnings yield is now just 3.57%, which is very low historically. The S&P 500 is trading at approximately 23 times forward earnings. That's about 40% higher than its 20-year average, approximately 16 to 17 times. So, investors are paying more for the same, or slightly improved, earnings. So that means this equity risk premium curve is actually something super important to watch. It would have warned us back in 2000, when the dot-com bubble pushed stock valuations way too high. Back in the dot-com bubble of the early 2000s, companies were going public with zero profits, and in some cases, even admitting in their filings that they might never achieve profitability. The Magnificent Seven now dominate the S&P 500. These 7 companies make up a massive slice of the index. As of May 2025, they accounted for 34% of the S&P 500's total value. That means just 7 firms out of 500 hold more than a third of the entire index. The remaining 493 companies share the other 66%. This chart shows earnings growth for the Magnificent Seven and the remaining 493 companies. In early 2024, the Magnificent Seven drove most of the growth, with profits up over 50% in Q1. But by Q1 2025, their growth fell to 21%. The rest of the S&P 500 grew more steadily, around 8 to 13% each quarter. The gap is clearly narrowing. And here's where the over-reliance is dangerous. The declining profits of the Magnificent Seven, combined with their outsized weight in the index, mean they could pull down overall S&P 500 earnings. During the dot-com bubble of the late 1990s and early 2000s, the US stock market, particularly the Nasdaq and to a lesser extent the S&P 500, became heavily concentrated in a small group of high-flying technology and internet companies. Firms like Cisco, Intel, Microsoft, and a wave of speculative dot-com startups saw their valuations skyrocket, often with little or no profits to justify the prices. This concentration masked underlying weakness in the broader market, as the performance of a handful of tech stocks disproportionately drove index gains. When investor sentiment shifted in early 2000 and tech earnings failed to meet inflated expectations, the bubble burst. The Nasdaq Composite lost nearly 80% of its value, and the S&P 500 fell by almost 50%, revealing the risks of a market too reliant on a narrow sector. At Gleneus, we actually believe the equity risk premium could return to more favorable territory in the coming years. While the ERP is near zero today, it's not a fixed state. It's simply the difference between the stock market's earnings yield and the 10-year Treasury yield. If corporate earnings stay flat but bond yields fall, the ERP can move back into positive territory. And that's a real possibility. The 10-year yield is elevated today because of the Fed's aggressive rate hikes, in 2022 to 2023, a direct response to inflation spiking to 6.6%, the highest since 1981. The Fed hiked the federal funds rate by 5 percentage points, its sharpest tightening in decades. But that phase may be ending. The last cut came in December 2024, and forecasts suggest the Fed could lower rates by 200 basis points through 2027. If so, the 10-year Treasury yield, now around 4.3%, could fall closer to 3.2%. This matters because the 10-year yield is deeply connected to the Fed's short-term rate. While the Fed sets the overnight lending rate, the 10-year yield reflects investor expectations about inflation, growth, and policy. As rate cuts materialize or even just appear on the horizon, the 10-year yield tends to fall. If that happens, and earnings yields remain stable, the ERP flips back to positive. That means investors would once again be compensated for taking equity risk. The market may be skating on thin ice today, but that ice could very well thicken soon. Thank you for watching. You're here to feel good and feel well. This is Glenneus.